Welcome to the National Credit Awareness and Resolution Association podcast at NCRRA.org, your source for navigating debt repayment challenges during tough economic times. Today we'll experience how small business owners can more effectively use creditor tools, specifically credit risk ratings or loan grades. NCRRA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Credit risk ratings and loan grades. This is really important to understand. Regulated lenders, for example, apply credit risk ratings or loan grades to business loans as part of a credit risk management framework. The loans with acceptable risk of repayment are rated as pass, and other ratings are made for loans that exhibit potential weaknesses and those with well-defined weaknesses or worse. Delinquency is but one of the key risk metrics or indicators of a problem loan situation, but that usually comes after several red flag warnings well in advance. The credit risk ratings framework enables management to assign an appropriate reserve amount from earnings against potential losses for a given loan. It is imperative that the credit risk rating system is effective in always assigning risk ratings accurately, and that any necessary changes in ratings are also done on a timely basis. Pass ratings often range from, say, 1 to 6, depending on the quality of the pass-rated credit. For example, a loan secured by a certificate of deposit, in other words, it's cash secured, is perhaps the highest quality of a pass-rated credit, or it's a rated 1. Other pass-rated credits will have more credit risk, but are still acceptable, rated 2, 3, 4, 5, and say 6. Creditors will often include a watch list designation, which is attached to any rating, like a 6 watch, which means there is an uncertainty that will be followed up on for resolution. Now, let's talk about criticized or classified risk ratings through their continuous monitoring. So outside the pass rating, say ratings from 1 to 6, is the criticized risk rating called special mention, followed by the classified ratings of substandard, doubtful, and loss. All such loans may be called criticized loans, however. Primary lending officers have the first line of defense responsibility to identify emerging credit risks that might result in a downgrade from a pass rating with oversight support from management. Creditors often have an independent loan review function or credit review and outside consultants who will independently review loans to confirm the accuracy and the timeliness of the risk ratings and their changes. Downgraded loans are regularly reported to senior management and the board of directors of a financial institution. Creditors need to assess the debtor's overall financial performance, the credit quality, regularly. Key repayment sources include the debtor's current and stabilized cash flow capacity, credit report performance, management's character profile, the loan original purpose, current sources of repayment, collateral condition, guarantor support, and then, of course, payment status. By the time credit weaknesses are identified, this usually results in a diminished ability to make the required payments, and the loan becomes delinquent. Creditors use standardized risk rating definitions as defined by regulatory agencies, for example, the FDIC Manual of Examination Policies. And these ratings, these classified risk ratings, have actual specified definitions. Let's go through them. First, special mention. It's a criticized rating. A special mention asset has potential weaknesses that deserve management's close attention. If left uncorrected, these potential weaknesses may result in deterioration of the repayment prospects for the asset or in the institution's credit position at some future date. Special mention assets are not adversely classified and do not expose an institution to sufficient risk to warrant adverse classification. So special mention is a criticized definition. Now we're going to go to a classified definition. The first one is substandard. Substandard loans are inadequately protected by the current sound worth and paying capacity of the obligor or of the collateral pledged, if any. Loans so classified must have a well-defined weakness or weaknesses that jeopardize the liquidation of the debt. They are characterized by the distinct possibility that the institution will sustain some loss if the deficiencies are not corrected. Okay, the next classified rating is called doubtful. Loans classified doubtful will have all the weaknesses inherent in those classified substandard, with the added characteristic that the weaknesses make collection or liquidation in full on the basis of currently known facts and conditions and values highly questionable and improbable. And then the last classified rating is called loss. Loss classified loans are considered uncollectible and of such little value that their continuance as bankable assets is not warranted. This classification does not mean that the loan has absolutely no recovery or salvage value, but rather it is not practical or desirable to defer writing off this basically worthless asset, even though a partial recovery may be effected in the future. This short ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at tunabudget.com to tune into the Tuna Budget Problem Podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. So why is this risk rating classification, these loan grades, important to you? First, stakeholders sleep better at night when their loans are risk rated as pass. Creditors are expected to operate with safe and sound practices, and asset quality, be it their loans or investment securities, is paramount to their survival. Financial institutions are not supposed to have huge piles of classified underperforming or worse, non-performing loans on their books. If your loan is downgraded, you can expect to see pressure from the creditor to get those loans back to performing status as they should be, or get them to a zero balance as soon as is reasonably possible. Creditors can have only so many classified loans on their books before its capital adequacy becomes an issue, together with regulatory repercussions. Start to see why there could be some real pressure on you. Of course, management may also face the potential of missing out on bonuses because of numerous problem loans. Loans are traditionally risk-rated a pass rating if they are loans with strong or acceptable repayment sources. As financial conditions deteriorate, however, your loan's credit risk rating could be lowered, and people won't be sleeping at night as well at night either. Next, creditors are expected to assign both accurate and timely risk ratings. Management and lending personnel have been criticized by regulators for their failing to downgrade loans accurately or on a timely basis. Management may be ignorant or disregard warning signs and red flags about your business and industry risks. Management may even be neglectful if they know the risk will fall or fail to assign them. If they know the risk but fail to assign them because of the material impact it could have on the lender, it becomes increasingly a problem, not properly assigning accurate credit risk ratings, especially when the lender lacks the ability to shore up its own capital base. So you can see how much pressure can develop and how quickly. Lenders also have been known to be in violation of safe and sound lending practices such as over-lending, making over-advanced disbursements, being too speculative, dominating personalities and influential connections, friendships or conflicts of interest. So they're not perfect, Primary loan officers and others can lose their bonuses or even their jobs if they have too many criticized loans in their portfolio. You can start to see why creditors may consciously make inaccurate or delayed risk rating calls. They don't want to be caught with the problems, right? That approach does no one any favor, including you. I guarantee you that. Next, when your loan is risk-rated special mention, because it's going to go from pass to special mention, sub, and then doubtful and loss. It's going to progress in that order, hopefully. Hopefully it doesn't happen, but that's how they're graded if the risk increases as such. But loans that are risk-rated special mention are criticized, again, and not classified. You should expect more attention and monitoring efforts once your loan is risk-rated special mention. The expectation is that special mention rated borrowers will return to a pass rating in the very near future, like months, or it will likely deteriorate further and become a classified or substandard or worse. But special mention is really a transitory rating of sorts for a shorter period of time. The rating is expected to be upgraded to a pass or downgraded to a sub, but not endlessly sit as a special mention rated loan. So you can see you're kind of almost boxed in with timing. They're going to expect it to get better fast, or things are going to likely deteriorate. Special mention rated loans get management's special attention, as uncorrected credit risk may result in deterioration of repayment prospects. So creditors are going to be asking more questions and for more financial information. They will review and adjust inadequate loan documentation, review the condition and or control over collateral, declining economic or market conditions, or declining trends on your balance sheet and income statement. Are you going to cooperate, though, or not? Next, when your loan is risk-rated substandard. Loans that are risk-rated substandard, sub, are classified loans. This rating is another story altogether, and this is where it gets very serious. Insufficient cash flow is a standard reason for the sub rating, and this underscores why you need to be armed with your pro forma cash flow statement, a month-by-month projection for 12 months showing what the available, though insufficient, cash flow will be for repayment purposes. The promissory note and loan agreement will likely need to be modified, or a change in terms agreement negotiated and signed to reflect necessary adjusted terms. This will include a change in payment amount, the timing of payments, a reduced interest rate, payment deferral, or an extension of the maturity, etc. The negotiations may also include addressing violated loan covenants, taking additional collateral, or any other type of agreement to shore up the creditor's repayment sources. Ideally, you'll want to negotiate your repayment well before it becomes a substandard credit, like 90 days before. Depending on the severity of the repayment sources, the accrual status may remain on accrual or be changed to non-accrual. Next, when your loan is risk-rated doubtful. Loans that are risk-rated doubtful indicate that the credit has deteriorated to the point where there will be loss in the repayment of the loan balance or some portion of it. The loan will be placed on non-accrual, and the creditor will no longer be taking interest income on the loan. This rating means that because of certain unknown factors that may strengthen the credit or work to its advantage, the amount of loss cannot readily be determined at that time. So it's a temporary rating as well. But as soon as those factors are figured out, like a new appraisal or progressing down the liquidation proceedings, or there's a capital injection or taking additional collateral, verification of environmental risk, or even a refinance at another institution, a loss amount can then be determined once those factors are figured out. Depending on the circumstances, it is possible a percentage of the loan can be risk-rated sub, and another percentage is doubtful, and then the rest rated as loss. Of course, once the deficiencies are figured out and the loss is charged off, then the rest will probably sit there and remain as a sub non-accrual for some time. When your loan is risk-rated loss, let's talk about that one. Loans that are risk-rated loss are uncollectible are no longer bankable assets. The loan balance must be written off in the period it is deemed to be uncollectible. That doesn't mean you no longer owe the money. It is to the contrary. Unless and until it is formally and legally discharged or otherwise repaid, it is still owed, interest and all. Creditors will make every effort to collect as much of the loan as possible, even if it internally charged off a part of it as a loss on its books. Creditors collect recoveries, monies from loans previously charged off, all the time. Next, understand what these credit risk ratings really mean. You have to understand what really we're talking about. Here's the point. You need to understand what these risk ratings really mean, because if you have to, you can ask, first of all, ask the creditor what your loan is risk rated. And they may or may not tell you, but fight through and get it. Find out what the risk rating is. Okay? They may call it a loan grade. It will change from time to time as your credit risk changes as well. But understanding these ratings will help you understand what is happening with the creditor. And regardless of the risk rating, pass-through loss, your promissory note, and an unconditional and unlimited individual guarantee will require full repayment regardless of the internal risk rating and the accounting treatment of any loss portion and what have you. The creditor system will be able to produce a statement showing your loan payment status, including all interest, fees, and costs owed at any time. But in summary, knowing what the risk rating is gives you a little bit of an idea as to how much pressure you can expect, and they'll definitely convey that to you, and it gives you the ability to understand the big picture. Well, thank you for joining us. Today we covered the creditor tool risk ratings, credit risk ratings, or loan grades, as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at NACARA.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. And until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.